Vanguard LifeStrategy was made broken. And you know what the funny part is? It was actually designed that way on purpose. But this is actually a far bigger issue than you might think. Why? Well, you need to consider that Vanguard LifeStrategy is one of the most popular funds in the UK. You might think, well, Nick, it's not that much of a bigger deal. There's lots of choice out there, so it doesn't really hold that much weighting. Well, consider this. Vanguard LifeStrategy Funds make up 3 of the top 5 most popular funds in the UK, as found by the Interactive Investor last year. LifeStrategy 80 comes in second, LifeStrategy 100 came in third, and LifeStrategy 60 came in fourth. So there's a lot of British pounds mixed up in these funds, which are largely weighted towards equities. If I was sat watching this video right now, I'd probably snigger and think, well, Nick, it can't be that broken if it's that popular. It doesn't really add up. Look, credit where credit's due. Vanguard's LifeStrategy funds are extremely well packaged and marketed. In the world of investing, the vast majority of customers don't know enough to feel comfortable to put their hard-earned money into the markets. It's scary and it's definitely uncertain. But this is why the LifeStrategy funds are so popular, as they're truly really easy to understand, and they provide an investment plan for life through 5 simple funds and 1 simple methodology. It must be such an easy sell for financial advisors. It's so easy, in fact, that one of my family members has actually asked me very recently what my recommendations might be to invest a significant 5-figure sum of money. But as you know already, I am not a financial advisor, so nothing I say should be taken as financial advice, but I could share my plan and what I would do with the money. As part of me trying to educate my family member on what my plan would be, I would actually start out by explaining the Vanguard's LifeStrategy funds, as they're really easy to understand, and then it helps with the conversation around risk tolerance and how far you're out from retirement age and those sorts of things. Once you've gone through this, it's easy to identify what sort of equities to bond ratio you're looking for based on the Vanguard's LifeStrategy funds. If I had to choose for myself, then I probably would use a LifeStrategy framework, but I wouldn't use a LifeStrategy funds because of how the equities in the portfolio are balanced. I've actually done a full breakdown of 3 of Vanguard's most popular funds, being LifeStrategy 100, the FTSE Global All Cap and the FTSE All World ETF, which includes looking at the weightings and my issues with them all. I'll put a ribbon in the top right so you can see further details, but I'll give you a little bit of a summary here. If you wanted a fund which gave you exposure to the global equity markets, then you would be spoilt for choice. But reasonably, you'd want a fund which is well diversified across all regions of the world, and most importantly, you'd want them weighted appropriately for what the global landscape looks like. So, for example, if France made up 3% of the global market, then you'd want about a 3% exposure to the French market, right? Well, this is why LifeStrategy is broken for me, and it's all about its weighting of the UK. In any well-diversified global ETF, you would expect roughly 4% weighting to the tea-fueled British economy. But LifeStrategy not only bucks this trend, but it stomps all over it. It has a weighting to the UK of 21%. Yes, 21%. Over 5 times the allocation of the UK in the global markets. This means that it's likely, and if not certain, that your performance isn't going to track the world markets properly. If the UK underperforms, then it's not going to be good for you at all. A little bit more on the UK's performance and its impact shortly. Before we get into the next part of the video, if you want to support the channel, then the least effort thing you can do is simply liking this video. And if you like videos around investing, then why not consider subscribing? If you'd like to go further than that, then I've actually set up a Patreon page where you can join for as little as £2 a month, which gives you access to my private Discord server, which I'm on a lot of the time if I'm honest. Link should be in the description below. No matter what level of support you give, I appreciate it all, so thank you. So, back to the video. So the real question we have here is, why is LifeStrategy weighted this way? Surely there's some extremely intelligent people at Vanguard, otherwise they wouldn't be as big as they are now. So why would they make such a bold and weird choice to do this? Well, the actual answer isn't what you'd expect. As a special treat, I've actually asked my good friend Chris Bourne from the YouTube channel Chris Bourne Tax-Free Investing to give you an overview of the history pre-Vanguard LifeStrategy and the actual challenges Vanguard faced when introducing the LifeStrategy funds in the first place. To give you a little bit of background on Chris, during the hours of 9 to 5, he's actually a financial advisor and actually deals with Vanguard as part of his job, and he has done for a good number of years, but uses the little hours he has outside of the 9 to 5 to run his YouTube channel. Anyway, I'll hand it over to Chris.
Thanks, Nick. Yes, it's fair to say that the UK investment landscape was very different when LifeStrategy was introduced. June 2011, when the range was first launched, seems like only yesterday in some respects, but almost a lifetime ago in others. The types of funds that dominated at that time were heavily weighted to the UK, and that's because of the popularity and success of strategies like the Invesco Perpetual Income and High Income Funds, both of which were managed by Neil Woodford. We all know what's happened since then. Those funds were well renowned for being heavily allocated to defensive sectors like pharmaceuticals and tobacco, and they held big positions in stocks like GlaxoSmithKline and AstraZeneca, British American Tobacco, Imperial Tobacco, and so forth. Companies that you could rely on to pay predictable streams of dividends. The influence of these funds was such that the average UK managed fund was about 62% allocated to UK listed companies. There was also definitely a trend for following so-called star fund managers. I remember that in the year prior to LifeStrategy being launched, another very well-known UK fund manager called Anthony Bolton launched an investment trust to much pomp and circumstance. He'd previously famously managed the Fidelity Special Situations Fund for nearly 30 years, delivering annualised growth of over 19% a year. After stepping down from that in 2007, he moved to Hong Kong and launched the Fidelity China Special Situations Trust in 2010, and it was fully subscribed at £460 million on issue. It actually got off to a disastrous start, but did eventually recover before he stepped down after about 4 years. Against that backdrop, LifeStrategy quietly slid onto the market with almost zero publicity from what I can remember. The only thing I do remember is that they decided to add a 25% home bias to UK equities and a 35% home bias to UK fixed income, purely because UK investors were used to and comfortable with a higher UK allocation. That was the only reason. It was just so that they could compete. The Vanguard brand was almost totally unknown here back in 2011. But since then they've pretty much revolutionised investing in the UK and ruffled plenty of feathers by forcing other investment houses to lower their costs in order to compete. They've also improved diversification because people are now much more comfortable with global market cap weighted investing. Back over to you, Nick.
Thanks, Chris. If you're interested in hearing more from Chris, then I'll make sure to put his YouTube channel in the first link in the description below. He really knows his stuff. Okay, so no fund is perfect. Well, I think VWL's perfect, but let's be honest, I'm very biased. Vanguard were kind of forced into doing this with LifeStrategy, as the market was asking for it at the time. If they didn't, then it probably won't be as popular or profitable as they are today. But how much has this cost investors? Well, let's take a look. Vanguard LifeStrategy launched their funds in the middle of May 2011. Since its inception, it's grown by 155%. But when I compare it to my fund of choice, the FTSE All World ETF, which in my opinion is correctly weighted, over this period it's grown 162%. So a 7% difference. Is it really worth getting your knickers in a twist about? Just 7%? Well, have a think about it. If that 7% compounds over life and continues at the pace, it could be very significant. To demonstrate the impact that it's had so far, consider there's roughly 25 billion invested across all the Vanguard funds. This is a bit of a guesstimate, as the only data I can find is that 7.8 billion is invested in LifeStrategy 60, which at the time of reporting was the biggest fund out of the 5. So I think 25 billion is roughly reasonable. Well, based on this, a 7% underperformance means investors have missed out on a cool combined total of 1.25 billion. That's a lot of retirement money missing from the economy that could have been there. You could easily argue that it could have been very different if the UK had been overperformed. And rightly so, we wouldn't be having this conversation at all. And then in the future, the UK could have a bit of a surge in performance also. But personally, somebody investing in something as passively as LifeStrategy, I think any sort of under or overperformance is pretty bad for everyday investors. Their futures shouldn't be left to blowing the global market winds, especially betting quite big on the UK doing well in the long term. With all that said, I don't think Vanguard have an easy way out of this situation. In my opinion, they're a bit like Ford or any other traditional car manufacturer 5 years ago. They could see competitors with electric cars were better placed for the future, which highlighted the flaw in their own products. To move to this new type of vehicle would be extremely costly, and their existing products were really popular and really profitable. So why change? Change would mean higher costs, and who wants higher costs, as this means lower profits? But how long do you let a smaller competitor nibble away at your lunch before it starts to be a real issue? Again, look at the traditional automakers. They're all in a bit of a mess at the moment, trying to catch up with Tesla and NIO. I think Vanguard need to make bold moves, just as they did back in 2011 with the LifeStrategy Funds. At that time, these funds were a game changer in the market, and it was a complete leap of faith to onboard British investors in this way. And you know what? It's paid massive dividends for them. But they need to make similar game-changing moves now if they want to reach that new level in 2031. I think the LifeStrategy and target retirement funds formulas are pretty spot on and in some ways are very timeless. But even saying that, I wouldn't touch them with a barge pole. But I would be extremely interested if they could sort out the UK element. Otherwise, I might be persuaded to leave Vanguard at some point if somebody could deliver a better product for me. Anyway, these are just my thoughts. I think the debate over the best investment is only 5% of the battle. The real battle is just getting invested in the first place. If you invest in LifeStrategy funds, then I respect your choice of investment, and it's 10 times better than not being invested at all. I'd really like to know your thoughts though. Are you invested into any of the LifeStrategy funds? If so, which one? Do you agree or disagree with my thoughts? And would you want to see Vanguard do anything differently? That's all for this one. See you in the next one.